Welcome to the fourth class of the Introduction to Financial Markets course. Today, we're going to dive into a key topic for any investor who wants to make well-informed decisions: fundamental analysis. We'll explore how to value a company, the difference between price and value, and one of the most popular methods, the discounted cash flow, DCF, as well as some of the most commonly used financial ratios. So, if you're ready to learn how to analyze companies like a pro, stay with me until the end. And don't forget to subscribe to the channel and hit the notification bell so you won't miss any of our upcoming classes. Disclaimer: the content of this channel is for educational and informational purposes only. It should not be considered financial advice, investment recommendations, or an invitation to engage in trading in financial markets. Always conduct your own research and consult with a financial professional before making any investment decisions. Investments carry risks, and we do not guarantee any specific outcomes. Now, let's get started. What is fundamental analysis? Fundamental analysis is a methodology that helps us determine the intrinsic value of a company. What does that mean? It means that it helps us understand how much a company should be worth based on its financial data and future performance, not just on what the market says. Unlike technical analysis, which focuses on charts and historical prices, fundamental analysis dives into the figures behind the company: its sales, assets, liabilities, cash flow, and much more. The difference between price and value. Here comes a crucial concept: the difference between price and value. The price of a stock is what the market is willing to pay for it at any given time. This price is influenced by supply and demand, market sentiment, and often emotional or speculative factors. But value, on the other hand, is what the company is truly worth based on its ability to generate income in the future. A common mistake that beginner investors make is confusing price with value. Just because a stock is cheap doesn't mean it's undervalued, and if it's expensive, it doesn't always mean it's overvalued. This is where fundamental analysis comes in, helping us determine the true value of a company. The discounted cash flow, DCF. One of the most widely used methods for valuing a company is the discounted cash flow or DCF method. How does it work? The DCF allows us to calculate a company's present value by estimating the cash flows it will generate in the future, and then discounting them at an interest rate that reflects the investment's risk. Steps to calculate the DCF. Projection of future cash flows. Here, we estimate how much cash flow, the company will generate in the upcoming years. This might seem complicated, but it essentially involves analyzing the company's past performance and projecting what we think will happen in the future, considering factors like sales growth, profit margins, and economic conditions. Discounting those cash flows. Why do we discount them? Because money today is worth more than money in the future due to factors like inflation and the risk that future earnings may not materialize. We use a discount rate, which is often the company's cost of capital or the return that shareholders expect to earn. Calculation of present value. Once we have the future cash flows and the discount rate, we sum the present values of those cash flows to get the company's value today. Be cautious here. While the DCF is based on objective data, such as historical sales and costs, future predictions can be quite subjective. For example, if we overestimate the company's growth, we might arrive at an inflated valuation. Key financial ratios. Besides the DCF, there are several financial ratios that are extremely useful for evaluating a company's financial health and comparing it to its competitors. 1. Earnings per share, EPS. This ratio shows us how much profit the company generates for each share outstanding. The higher, the better, because it means the company is more profitable for its shareholders. It's important to look at how EPS evolves over time. Is it growing, stagnant, or declining? 2. Dividend yield. If you're looking for regular income through dividends, this ratio is key. It tells us what percentage of the stock price is returned to the investor in the form of dividends. The formula is simple. Dividend yield equals annual dividend / stock price times 100. This ratio is essential for investors seeking a passive income strategy. 3. PER, price to earnings ratio. This ratio compares the stock price to the profit it generates. It tells us how many times the net profit is included in the stock price. A high PER might indicate that the market has high growth expectations for the company, but it could also be a sign of overvaluation. PER equals stock price/earnings per share, EPS. What's interesting about the PER is that it should not be analyzed in isolation. We must always compare it to the PER of other companies in the same industry. For example, if a company has a PER of 20, but its competitors have a PER of 10, it might be a sign that the market is paying too much for that company. How is fundamental analysis different from technical analysis? How do they complement each other? Now, let's briefly discuss how fundamental analysis differs from technical analysis and how both approaches can complement each other. Fundamental analysis focuses on understanding the underlying value of a company by studying its financial statements, business model, competitive advantages, and market conditions. It seeks to answer what is the intrinsic value of the company and whether the stock is undervalued or overvalued based on this analysis. Technical analysis, on the other hand, looks at price trends and patterns in stock charts to predict future price movements. Technical analysts believe that past price actions can help predict future behavior, so they focus on when is the right time to buy or sell. Complementary use. While fundamental analysis helps you decide what to buy or sell, technical analysis helps you determine when to do so. Many successful investors use a combination of both. For example, after identifying an undervalued stock through fundamental analysis, you can use technical analysis to identify the best time to enter or exit a position based on market trends and price movements. How to be more specific when analyzing a company. When conducting fundamental analysis, it's important to be thorough and look beyond basic numbers. Here's how you can be more specific. Understand the industry. Is the company in a growing, mature, or declining industry? How does it compare to competitors? Are there barriers to entry or regulatory hurdles? Examine profit margins. Beyond just revenue, it's crucial to assess profit margins. A company may have growing sales, but if costs are rising faster, profitability may be shrinking. Look at gross, operating, and net profit margins to understand where value is being created or lost. Debt levels. Analyze how much debt the company has relative to its equity, debt-to-equity ratio. High debt levels could signal financial risk, especially if interest rates rise. Management quality. Don't overlook the importance of the leadership team. A strong, experienced management team can make a significant difference in a company's long-term performance. Look at their track record and see if they have delivered consistent value. Growth prospects. Investigate what growth strategies the company has in place. Is it expanding into new markets, innovating products, merging with other companies? A solid growth plan can indicate future value creation. Sustainability and ESG factors. In today's market, environmental, social, and governance, ESG factors are becoming increasingly important. Companies with strong ESG practices might have a better long-term outlook, as they are better positioned to handle regulatory changes and reputational risks. Other important aspects of fundamental analysis. Beyond the DCF and ratios, there are other factors we should consider when conducting a fundamental analysis. Industry growth. Is the industry growing, maturing, or in decline? This will affect the company's future prospects. Competitiveness. Analyze how strong the company's position is relative to its competitors. Does it have a sustainable competitive advantage like a strong brand or patented technology? Debt levels. A company's debt level is crucial. If it has too much debt, it could struggle during economic downturns or interest rate hikes. Management team. Sometimes we underestimate the importance of the people running the company. A management team with experience and vision is key to long-term success. That brings us to the end of today's class. As you've seen, fundamental analysis provides us with a solid foundation to make more informed investment decisions. It's not just about numbers, but about understanding a company's true value and its future potential. If you found this class interesting, don't forget to give it a like and subscribe to the channel. In the next class, we'll dive into technical analysis, another essential approach for investors. See you next time.